Hello, Joe, Al, and Andy. It's Brian from Queens, New York. All right. But it's been a while. For the third write-in.
Right.
Ooh, a little taking advantage of us. But it's been a while as you answered my first and second questions on podcast 275 and 303. God, remember those?
They seemed like yesterday.
That's just so good. What number are we on today? What is this?
By the time this airs, it'll probably be about 367.
So it's been 100 episodes ago?
Yeah, just about.
Wow.
So he's not exactly taking advantage of you. He just writes in periodically.
Yes. I continue to listen every week. Got to tune in because never know what Joe might say next. Oh, jeez. I don't know how to take that. Yeah.
It could be a dig or it could be a compliment.
I'm 45 years old, making $120,000 a year. As a school teacher, also expect about an $80,000 pension at age 55. I contribute to and max out my 403B, Roth 457, and backdoor Roth IRA. Hoping to continue to max out until retirement eligibility, including the 50-year catch-up rule. These accounts currently total about $725,000. The 403B and 457 do not have small cap value options. So as I make the contributions to the 403B, 457 of about $4,000 a month out of my paycheck invested in the total market S&P and midcap index funds and 7% into the fixed account, doesn't make sense to do an exchange of my total market index fund and my Roth IRA for the same $4,000 per month over the next few years and dollar cost averaging the small cap value index fund until I reach the 20 or 10% overall threshold in my portfolio. Okay. How much does he have in the Roth IRA? He's got everything in 725.
Well, yeah, it doesn't say. 725 is the total.
So he wants to get to 70 to $140,000 in small cap value.
Right.
Okay.
Yeah, it's 10 to 20%.
I also recently started a taxable brokerage account and had the Fidelity Mutual Fund version of the total market index fund, but sold that and bought the ETF iShare equivalent for the following reasons. Is it true for better tax efficiency, it is more beneficial to hold ETFs in a taxable brokerage account than regular mutual funds because there is less of a short-term and long-term capital gain and dividend distributions? Can you explain this? Thanks always for all the terrific information, Brian. Okay, Brian's getting in the weeds.
Yeah, well, let's start with the first question.
He's trying to eke out a little bit more return. So Paul Merriman's a big fan of small cap value.
Sure.
And so if you look at small cap value are small companies that are underpriced. That means they're distressed of some sort. So if you take a smaller company that has a lot of risk that is underpriced because it could be distressed for some reason or out of favor, it has a lot more room to grow. So the expected return of that particular asset class is higher than, let's say, a large company growth stock that is already built and producing, goods and services that is in a very strong industry, let's say.
Yeah, and the rate of return has to be higher because otherwise who would invest in it?
Why would you take the risk?
Why not? If it's the same return, let's go with the strong company.
Exactly. But the risk premium is what they call it. Doesn't happen every year. You have to buy the overall asset class and hold it for a long period of time. And over a long period of time, historically, smaller companies have outperformed larger companies. Is that saying that will continue to happen? It should, but who knows what, growth companies have outperformed. Small companies have gotten hammered, but then they come back, value companies over growth and so on. There's large debates, but the academics say that value will outperform growth because there's more risk in value type companies, and smaller companies will outperform large companies because there's more risk. So Brian here, a buddy from Queens, says, I want to load up on this small cap value. I want to get a little catnip.
Right. 10 or 20% of the portfolio.
Yeah, that's a little rich.
But
he's 45 years old and he's going to have a huge pension. So What the hell? I would put 20% of my portfolio in small cap value right now. But if he doesn't have the 140,000 in the Roth, well, but I wouldn't necessarily dollar cost average and say, hey, I'm going to take this from that and do whatever. I would reorganize my portfolio to what it should look like today and make those trades today and then move on.
I agree with that. And the thing is, I mean, if you go back the last 100 years, small cap value has outperformed, the total stock market, particularly larger companies, by a factor of 2 or 3, sometimes more percentage on an average annual compounded basis. Now, so not only is it good to own them anyway, just because of the higher potential rate of return, the last decade, that has not been the case. In fact, larger companies have done better. There's something called reversion of the mean, which means there's probably more opportunity anyway in smaller in value. So you would want to go ahead and invest it, and all the money that you can put in it, up to 20% of your portfolio. Go ahead and do it now. I agree with that.
Yeah, I would just reallocate to whatever your allocation is. We are not recommending people to go into any particular investment, any type of asset class.
Yeah, that's true. And
he is asking to say, hey, I want to put 20% into this particular asset class. We explain why that asset class is popular.
Right.
And why Paul Merriman likes it.
Yes.
But we are not recommending that.
No, we're not. And 20% might be a little rich, because that's a pretty good allocation. But I've got
45.
I've got small cap value in my portfolio, and I'm older, and I will always, because it's a great asset class.
Yeah. So there you go. ETFs. Yeah. ETFs and index funds are almost identical. It's just how they're created and structured. ETFs were really created to trade for like the big institutions because they trade like stocks. Mutual funds trade at net asset value. I think you're getting way into the weeds here. You have a brokerage account that you're just starting, and you're changing the index fund into an ETF. If you look at the distributions on both of those, it's going to be almost identical.
Pretty similar, right?
Because an index fund is not trading. An ETF still has to reconstitute the ETF as well. And that's when an index fund trades, is that if they're stocks that come out of the index, so like the S&P 500, right? There's roughly 500 companies within, but it's not the same 500 companies. Some of them fall out of favor. Some of them, come in. And so they have to reconstitute to make sure that the index is pure. And so that's when those trades happen. So there's not a ton of, if you're in an actively managed mutual fund, that's when you get more dividend distributions. That's when you get interest, and that's when you get turnover, and that's when you get capital gains, and so on and so forth. So if you have an index mutual fund versus an ETF in the same index, you're not necessarily going to get killed in the overall taxes. But yes, overall, on a high level, ETFs are more tax efficient than mutual funds.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.